Good morning, Happy New Year, and welcome to the ParkBridge Wealth Management Winter Webinar Series. This program is entitled Long-Term Care Costs and Options at Varying Degrees of Wealth. For those who don't know me, my name is Jonathan Shenkman. I'm the President and Chief Investment Officer of ParkBridge Wealth Management. In that role, I serve in a fiduciary capacity to help my clients achieve their financial objectives. The goal of my program is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning, and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 20 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in a variety of periodicals, including Barron's, CNBC, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, and Trust and Estates Magazine, to name just a few. You can see all my work on my website at parkbridgewealth.com/articles, or by following me on social media at Jonathan on Money. Additionally, you can check out my weekly podcast, which is also called Jonathan on Money, and you can listen to that in Apple, Spotify, or wherever you get your podcasts. Today, we're privileged to hear from Elizabeth Forspan, managing attorney at Forspan Klear, based on Long Island, New York. Elizabeth practices in the areas of elder law, trust and estates, and taxation. She regularly assists clients in achieving their Medicaid planning goals in a tax-efficient manner through practical and considerate planning techniques. Elizabeth speaks throughout the United States on various aspects of elder care planning, tax law, and estate planning. She has also been featured in New York Magazine, MarketWatch, and has been quoted in the New York Times. Prior to co-founding Forspan Klear, Elizabeth was the managing attorney of a leading elder law and trust and estates law firm. She also served as a tax manager with Ernst & Young. Today, Elizabeth will be speaking on long-term care costs and options at varying degrees of wealth. And with that introduction, I'll now turn the program over to Elizabeth.
Jonathan, thank you so much. You always have the most wonderful introductions. And I appreciate you having me on this morning. Good morning to all the early risers. I'm not typically one of them, but for you guys and for Jonathan, I'm happy to be this morning. And I apologize in advance. There are no slides today. Now, some people will be happy with that, and some people will be unhappy with that. So for those of you who are not happy about no slides, I'm sorry. It's quick, and I don't want to get bogged down in slides this morning, especially because I never usually move off of the first slide. If you need my contact information, Jonathan could provide it to all of you. Okay. So this morning, we're going to talk about the different ways and the different options to pay for long-term care. Now, there are, of course, a number of different ways to pay for long-term care. And when we speak about long-term care, what am I referring to? I'm talking about nursing home care, assisted living care. All right. So this is something that all of us need to think about, of course, for ourselves. We need to think about it for our loved ones. And of course, we have so many professionals on the line today. We need to think about it for our clients. All right. So it's very interesting what we're going to talk about, hopefully interesting what we're going to talk about today, that typical programs to pay for long-term care that you might have thought about were not for higher net worth or moderate net worth people might actually be. So the first item that we're going to talk about is private pay. All right. Paying for care privately, meaning you use your own funds to pay for care. Now, just to give a sense of the cost of care, what are we looking at? So in the New York area, typically these days for home care, so if you hire an aide, a home health attendant through an agency, you're looking about $35 to $40 per hour, okay? And if we're talking about nursing home care in the downstate New York area, and surrounding areas, of course, we're looking at about, I would say, anywhere between, on average, about $18,000 a month, maybe $17,000 a month, depending on the nursing home. Now, of course, none of us want our loved ones to be in the nursing home. None of us want to be in the nursing home. But unfortunately, the reality is that many people do end up in nursing homes because the level of care that a person needs sometimes is too great to be provided for at home. So nursing home care, $17,000, $18,000 a month. Very, very expensive, of course. Now, assisted living is like a whole different ball of wax. So assisted living, there is a huge range. Assisted living on the cheapest side, you're looking at about $5,000 or $5,500 a month, but that could go all the way up to in excess of $20,000 a month, depending on the level of care. Now, assisted living is not nursing home care, and typically assisted living facilities are almost all private pay. When I say that, what do I mean? Most assisted living facilities do not accept Medicaid. There are a few, they're called ALPs, A-L-P, Assisted Living Program in New York, that do accept Medicaid. Now, Medicaid will not pay for the entire bill. They'll pay for the healthcare portion. And then typically the individual Social Security and pension or some of their income will go to pay for the room and board. Okay, so assisted living is a huge, huge range. And depending on, some people need memory care. If a family member or client needs memory care, that's going to be, and it's private pay, it's going to be very, very expensive. All right. So when we talk about private pay, that's where you or your client pays directly either an agency or an individual home health care attendant, let's say if you're getting home care, or if they pay the nursing home directly. Now, we have to be very, very aware of a lot of issues involved in private pay. When we talk about private pay, this is typically for our higher net worth clients, because as we mentioned, $35 an hour or $40 an hour, that's a lot of money. So most of our clients are not going to fall in that category, or they will fall in that category for a period of time until they may be able to qualify for other programs. There are some very important issues that we need to be aware of, labor and employment law. So I'm not going to get into the technical aspects of that today, but we all know many people who have private pay aides, and this applies to people who have private pay nannies for their children or housekeepers, etc. And there are a host of labor and employment law issues that we need to consider. When we're paying someone to take care of us or to take care of our loved ones, are we withholding for Social Security and Medicare, right? FICA, we all know what that is. Are we withholding for them? That's something that we need to do. Are we getting disability insurance? Are we paying into unemployment insurance for them? Are we making sure that they are working the requisite number of hours? If they're working in excess of the allowable hours, are we paying them overtime? Are we paying them time and a half? Are we satisfying the minimum wage requirements? And we know that minimum wage in New York is actually pretty high in relation to the rest of the country. So these are issues that people don't typically think about, but they are real. And unfortunately, I have seen many situations where it doesn't really end that well. So, so I'll give you an example. Someone works as an aide for a grandparent or a parent, and the relationship ends for whatever reason, and then the aide is paid off the books, and then the aide goes and files for unemployment, right? They go to file for unemployment, and then they look it up, and they're like, "Wait, you never paid into the system. Nobody ever paid in for you," and then it becomes a whole issue. Of course, if God forbid you have a home health attendant or an aide and they fall or they get hurt on your property, right? Is there disability insurance? What's the story over there? So these are real issues that we need to consider. Now, of course, when you pay an agency, a private agency, where they're the employer and you're not the employer, these issues kind of fall aside. But the problem on that end is that's where it gets really expensive, right? That's where you see the $35, $40 an hour. Whereas if you had a private pay aide where you were the employer, maybe you'd be looking at $22, $25 an hour. Okay, so these are important issues. The other thing that we want to consider is the deductibility of what you're paying for your care, right? So we all know about the medical expense deduction. And this is a real issue for our higher net worth clients, right? How are they paying for their care? They're using typically their income, right? Or they're taking excess distributions from their IRAs. Typically, we'll see with our higher net worth clients, they're taking money out of their huge IRAs. And of course, if it's not a Roth IRA, there's going to be a tax associated with anything that they withdraw from their IRA. They're taking in excess of the minimum required distributions, because the minimum required distributions may not even come close to covering what the cost of care is. So they're taking that out. And if they're paying an aide, let's say off the books, okay, I know that's a very a very loose term, but I think we all know what that means. They're paying their aid off the books. Are they going to be able to deduct that expense? No. Okay, so if they're paying an agency for their care, or if they're doing this the right way, then it would be considered a qualified medical expense that they would be able to deduct against their adjusted gross income, of course, subject to the 7.5% floor. So the deductibility of the of what they are paying for their care is very, very important for our higher net worth clients. Okay. The other thing that we want to consider for our higher net worth clients is if there's, two spouses and they're paying privately, which means they're using their funds to cover the cost of their care, and they're paying for one spouse who's ill, call it the unhealthy spouse, and they use up a lot of their funds, and now they might not be so high net worth anymore, and they may not have so much left over for the other spouse when the other spouse will need care. So that's something that we should all consider, because if someone needs round the clock care, this could be hundreds of thousands of dollars a year just for home care. Okay. And of course, we talked about nursing home care, which could be in excess of 250,000. And the reality is that in a nursing home, if you have a client in a nursing home and the client is paying privately, they're paying privately for the nursing home. That $20,000 a month is for the nursing home. But they're also going to want to have a private aide to come in, at least to give them breakfast in the morning, to get them dressed, maybe to put them into pajamas at night. And so that's an additional expense. So just something to think about. Now, what is the next option for paying for care? Of course, long-term care insurance. And many of you have heard me say this before. I'm a very big proponent of long-term care insurance. I think it works really well. I myself have a long-term care insurance policy. That's where you purchase an insurance policy that would pay for care in the future if you needed it, right? The type of custodial, long-term type care that we're talking about. Now, there's a lot changing in the long-term care insurance world, which I am not qualified to talk about. Jonathan is much more qualified to talk about that. He's helped a number of our clients with these issues, and they've all been exceedingly happy. So thank you, Jonathan. So there's the traditional long-term care insurance, which is kind of like a use it or lose it policy. Like it's almost like car insurance, right? You pay the premiums, you pay the premiums for all these years. And then if you need it, right, if you are not able to do your 2 out of 5 or now 3 out of 5 activities of daily living, and you put in a claim, then the insurance company will hopefully pay. That's kind of what I would refer to as the use it or lose it traditional long-term care insurance policy. And if you don't use it, or if your client doesn't use it, let's say they die prematurely, or let's say they live to a nice ripe old age and they're healthy, and then they just go to sleep one night and they don't wake up, which is, I guess, kind of the way that most people want to go. And then they never use their long-term care insurance. Well, what happens to it? Well, it's gone, right? That's the traditional policy. It's gone. A lot of people now are purchasing hybrid type policies where there's a life insurance policy with a long-term care rider, or there's some two components combined, where if you don't use a long-term care insurance and there's life insurance left over when you die, then your family can benefit from the life insurance. And I think that's really has gained popularity these days. And there's, of course, issues with deductibility. We're not going to get into the deductibility of long-term care insurance premiums just because there's not enough time today. That could be a course in and unto itself, and I'm sure there have been many about it. Not sure if I've done it, probably. But so we're not going to talk about deductibility, but there are certain deductibility issues of the premiums if it's with a life insurance policy, et cetera. Now, I think that these are gaining popularity because most of the insurance companies who were previously selling these long-term care insurance policies, those use it or lose it policies, are not doing so anymore, particularly in this region, because they didn't plan well. They didn't plan for people to be living this long. And many people are living with dementia, and they live very long lives, and they need care for a long number of years. And so those long-term care insurance policies are really not popular anymore and not that much available. And the other thing to note, and I'm sure many of you know this for yourselves and also for your clients who call you up in a panic, is that baked into those policies and to the contracts and those use it or lose it traditional long-term care insurance policies, the insurance company reserved the right to raise premiums. And boy, have they raised premiums. I had a client come to me this week that her policy was quadrupling. It was becoming so expensive. And they, of course, gave her different options to lower it. Now, the long-term care insurance is wonderful, but the problem that we see, there's a couple of problems we see with long-term care insurance, is that oftentimes it just doesn't pay enough for the care, okay? So people purchase a policy. Listen, there are some policies like those old John Hancock or Genworth policies that people have from back in the day, where it's going to pay $600 a day and it's an unlimited lifetime. There's no maximum and there's a 5% inflation rider. Those are wonderful. They don't really exist that much. I mean, sometimes we see it and I'm so excited and I jump out of my skin. I'm so happy for my clients, but those are few and far between. Typically what we see is that the clients will come in with policies that will pay $200 a day or $150 a day, something in that area. Well, we already talked about the cost of care. You know, you're looking at potentially $350 or $400 a day for private pay care, maybe more than that if you need a split shift, right? So there's, just to take a step back, there's a live-in, which is a 24/7 aid, right? Where if someone needs live-in care, it means they don't need their aide to be awake and up with them during the night. All right. And so what that means is very strangely, a 24-hour aide can actually just be paid for 13 hours under the labor laws. How does that work? I try to explain this to my clients all the time and they're like, wait, Liz, explain that to me again. So I'm gonna explain it. You can have a 24-hour aide or a live-in aide, but they're only paid for 13 hours because a live-in aide is an aide that has 8 hours of uninterrupted sleep and 3 one-hour meal times, okay? So the 8 hours of sleep and the 3 hours of mealtime is 11. 24 minus 11 is 13. So typically, if a client has a live-in aide, they will actually be paying for 13 hours and not 24 hours. But there are some clients who need a split shift, right? That means, and we've all seen this in our life, that the client or the patient or the person needs an aide to be up during the night because that individual gets up during the night. They need to go to the bathroom or they have dementia and they might be wandering. And so a split shift is where you have 2 aides each day, 12 and 12. Now, if you're paying privately for that, or if you're using your long-term care insurance for that, that's a lot of money. 24 times $35 or $40 an hour, that's a lot of money. So a big problem with the long-term care insurance that we see is that people just did not have sufficient coverage. The benefits are just not enough. And by the time people realize this, it's already too late, because in order to qualify for additional insurance or for long-term care insurance, you need to go through medical underwriting. It's like life insurance, right? And if you're older and you have some health considerations, let's say the person has diabetes or heart disease, something like that, they may not qualify. They're typically not going to qualify for long-term care insurance. And so that's the second big problem that we see. The second big problem is that it's too late. Many people just wait to get the long-term care insurance, and then they turn a specific age or they have some health consideration and they can no longer qualify. And another thing that we see is that people just say it's just too expensive, right? Now that we see that the premiums are going up tremendously, just like my client whose premiums had quadrupled, they just say, I don't want to pay these premiums anymore. I just can't afford it with all my other expenses. I don't remember a time that I have ever told a client to cancel their long-term care insurance policy, because I do think when we get into the nitty-gritty of the planning, it works to have it for a period of time. Not going to get into that today, unfortunately. So long-term care insurance, very important, not always available, not always enough. Okay, it's paying $150 a day and the cost of your care is $400 a day. It was great that you had the long-term care insurance and will help defray some of the costs, but yes, you still have a huge shortfall. So then we talk about the third option, which is not an option, so I shouldn't even call it the third option, which is Medicare, right? We know that most people at the age of 65 are going to qualify for Medicare. It's a health insurance program for nearly all Americans. And it's wonderful. What Medicare is wonderful, but it's health insurance. Medicare does not pay for long-term care. Medicare may pay for rehabilitation after a hospitalization, right? So we know that if someone goes to a hospital, if someone's let's call it checked into a hospital for at least 3 days, and then they need to go to rehabilitation, they have to go to a rehab facility, that Medicare will pay for some of their rehab, but not long-term care. Medicare may pay up to 100 days in a rehabilitation facility or to receive rehab. May, because not everybody is going to qualify for the 100 days. If their physical therapist or occupational therapist deem that they have plateaued and they are no longer getting any better, or they're not improving or making progress, then Medicare will stop paying. And the other thing to note is that even if Medicare does pay the 100 days, there is a copayment, a very large copayment, almost $200, that starts at day 21. So $200 a day, that is. So we have to consider that. Now, most of our clients, if they're in rehab and they're in their Medicare days, most of them, their Medicare supplemental will cover for day 21 through 100, the copayment. For example, we have I would say most of our clients, our older clients, have United Healthcare AARP as their supplemental. Most of them were in the F plan, F like Frank, which you can't get anymore. I think it turned into the G plan. That's going to cover, in most cases, the day 21 through 100 copayment. But Medicare after that is not going to be paying. Okay. It's a common misconception, but after 100 days are up, Medicare is not going to be paying anymore. And earlier, if the person has been deemed to not be improving. Okay, so then we're left with the Medicaid program. That's number 4 here, or maybe I should say 3A. The Medicaid program. So we typically think of Medicaid as a program for poor people, which is what it was designed to be. It was designed to be a health insurance program for indigent people. It has turned into a program for long-term care for not so indigent people. And the theory is, a theory that the government has, is that if you are willing to impoverish yourself, we are willing to pay for your care. Now, what we're not going to get into today is the 5-year look back and how you need to do planning in advance, right? We have to plan with our clients in advance for nursing home care, of course. Home care in New York still, I'll give you a little bit of an update. Home care still has no look back. We know that, or those of you who have seen me give a similar presentation or have seen me present on the Medicaid update before, know that in 2020, in April of 2020, they changed the rules where they were going to impose a 2.5-year look back for home care. Meaning they were going to go back and look at all transfers that you made in the 2.5 years prior to applying for Medicaid home care, for home health assistance. Now, that was a huge earthquake because New York, unlike pretty much every other state, almost every single other state, did not have a look back for home care. Meaning you could transfer assets on November 30th and December 1st, you'd be eligible for Medicaid. No look back whatsoever. And they changed that in April of 2020. But because of COVID, it has been pushed back. The implementation has been pushed back, where today there is still, thankfully, no look back for home care. Now, it is set to go into effect April 1st, 2024, which is in less than 3 months from now. But we anticipate it to be further pushed back. But as of today, that's what it is. So why do I mention this? If you guys have any clients, if you have any clients who you think might need home care within the next year, it'll be better to apply before April than after April. Okay. So the Medicaid program is for the indigent. But what does that mean? People create trusts. They create an irrevocable trust, one that has been tested by, whose provisions has been tested by Medicaid. They transfer their home into the trust. They transfer their brokerage accounts into the trust. They transfer their non-qualified annuities into the trust. That is a possibility if it's a grantor trust, which pretty much almost 100% of the time, these will be grantor trusts. And they wait the requisite period of time, and then they're eligible for Medicaid. Now, it sounds very easy. It is not, okay? Because when we do this planning, we have to be very mindful of a number of things. The tax considerations, which I'll talk about in just a moment. The financial considerations. Are we taking assets and putting them into a trust and taking them off the table for our clients? Those assets might be generating income, Is the trust going to allow the client to have income? The grantor, is it going to give income to the grantor? Is that going to create a Medicaid problem? Well, so we need to think about not only how it's going to be impacted in the Medicaid sense, but how the client is going to be impacted in a financial sense. Will they have enough to live off of in the next number of years before they need care, right? People are typically doing this planning when they're still relatively healthy. And so they can't necessarily divest themselves of all their assets and all their income and put it in a trust for some possibility that in the future they might need Medicaid. We have to figure it out, and we have to plan in a very thoughtful way to make sure that the client will have enough to use over the next number of years before they might need Medicaid. And that's why I always say this, and I know I sound like a broken record, but if you are doing Medicaid planning for your clients, you must be doing it together with the financial advisor. There is just no way around it, because as attorneys, we're qualified for some things, not much, but we're qualified for some things, but we're not financial people typically, right? We're not financial advisors. Clients ask me financial questions all the time, and I say that is a financial consideration, and that's where we need to bring in your advisor. We need to see what this is going to look like over the years. So that's very, very, very important. And then, of course, when we do the planning and we divest our clients of assets so that at one point in the future, they may qualify for Medicaid and have the government pay for some or all of their care, we need to make sure we're doing it in a tax efficient manner, right? If we are transferring assets into a trust, are we maintaining the basis step up, which is very important? Everybody's going mad and all crazy over revenue ruling 2023-2. That should not be an issue. You should still be able to obtain the basis step up so long as there are provisions in that trust that would have the assets includable in the taxable estate of the settlor. A limited power of appointment, income to the grantor. So we have to be very mindful of the way that we draft these trusts to make sure that if the trust needs to be revoked, even though it's an irrevocable trust, that it can be revoked. There's a way to do that in New York. And that we also maintain a basis step up. Now you might say to me, but wait a minute, if we're going for the basis step up, by definition, you only get a basis step up on assets that are includable in your taxable estate. And that's why, and that's a great point, but that's why we're talking about people at varying degrees of wealth, right? We talked about the private pay. We talked about the people on long-term care insurance. Now we're talking about the people who we don't care about the estate inclusion, right? We want the estate inclusion for the basis step up, but we're not worried about estate taxes because they're under the $6.5 million that or whatever it is in that particular jurisdiction. They're under the $13 million on the federal level, and they're under the state level in terms of their net worth. So in those cases, we want to be mindful to put our priority on the future capital gains tax issues and the income tax issues and achieve a basis step up. So we want to always be doing it in a very tax efficient manner. And we want to be doing it in a financially efficient and mindful manner. And so that's that on the Medicaid. No, that was very brief. Assisted living, as I mentioned, typically there are not going to be many assisted living facilities that take Medicaid. And so Medicaid is generally, but not always, going to be a private pay situation. There are situations where we have clients that are in an assisted living facility, paying the assisted living facility privately, but they also need an aid, and we have been able to actually get them Medicaid for the aid. Now, that is not an available option in every assisted living facility. We have to look at the contract and make sure that the services are not duplicative. But in many assisted living facilities, that is an option. The next question that you might have is, well, if they've divested themselves of their assets so that they can have Medicaid pay for the aid, how are they paying for the long-term, for the assisted living facility? And of course, that is something that we need to be mindful of in the planning. We need to put aside a specific pool of money, maybe not to the trust, because we can't have money from the trust go back to the individual if they want to qualify for Medicaid, but maybe we give a set amount of money to the children. Oh, I said it, I know. But we have to think about every case differently. Every case has to be thought of differently because everybody's family situation is different. Everyone's financial situation is different. Their assets are different and their income is different. We may have clients with a huge amount in assets, but their income is not what you would think it is. It's kind of on the low side. Or we may see clients who have low assets, but very high income because they have these huge pensions. Let's say they were a retired cop or a retired teacher. So every situation needs to be thought of differently. So in a half hour, I think I just gave you, the top 4 or 3.5 ways to pay for long-term care. It has been a pleasure as always. If anybody needs anything or has any further questions, I would be happy to answer them. Not now because I know we don't take questions, but everyone can email me. It's eforspan@forspanclear.com. Jonathan, thank you so much. It's been a pleasure as always.
Great. Thank you so much, Elizabeth. And if anyone has any specific questions, new business opportunities, or any other issues they'd like to discuss, please feel free to reach out directly to Elizabeth or myself where appropriate. And I'll be sure to include her contact information in the follow-up email of this program. As I mentioned at the onset, the goal of these programs stay up to date on timely wealth management related topics and to collaborate where appropriate. And I think we can all agree that the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. 3 more quick items before I let you go. First, my winter webinar series continues on January 16th on the topic of Use It or Lose It, securing the use of $13 million plus federal estate, gift, and GST tax exemption before sunset, featuring Jay Scharf and John Keel, both attorneys at law firm McDermott, Will, and Emery LLP. I'll send out an invitation to this program in the coming days. In the meantime, if you have a friend, colleague, or client who would like to be notified of my upcoming webinars, they can email me with the word webinar in the subject line, and I'll add them to my webinar distribution list. My email is jonathan@parkbridgewealth.com. Second, you can follow all my work on Twitter and Instagram at Jonathan on Money. You could also listen to my weekly podcast called Jonathan on Money, which is available on Apple, Spotify, or wherever you get your podcast. And you can watch my new daily financial planning clips by following me on YouTube at Jonathan on Money as well. Third, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees, and I thank you in advance for that. And with that, this concludes today's session. Please stay safe and healthy and have a wonderful day, everybody.